Hey guys, what's going on? Paul here. Welcome back to another Cardano video. It is great to finally be able to say that Liqwid Finance is live on the Cardano mainnet, and I'm joined by the team here today to have a walkthrough about what it is. First off, congratulations guys. Thanks for taking the time. It's a hectic time for you right now. Only went live a few hours ago, so I appreciate your time here to try and talk through what's going on and what we have. Very welcome to the channel.
Hey, Paul, thanks so much for having us again. It's a blast to be back on. And yes, it's been quite the marathon to get Liqwid V1 launched on mainnet, and we couldn't be more thrilled for the core team, for the community, and just for Cardano as a whole for what this means and represents.
Hi, Paul. Thank you for having us. It's a pleasure.
Yeah, you're very welcome. It's great to have you. It's definitely been a long road for you, I'd say, trying to get to this stage, and it's great to finally be here. So I suppose for people who don't know what Liqwid is, can you give the overview of what it is, or kind of what money markets are for people who are new to this type of thing? We'll get into more of the details then of what's live and what's coming.
Yeah, absolutely. So in a nutshell, Liqwid is a non-custodial liquidity protocol for interest rates. It allows lenders and borrowers to earn interest, to borrow assets from a protocol in an over-collateralized and variable interest rate fashion. So essentially, I can lend my ADA or my Cardano native assets and earn some yield on them. For the case of ADA specifically, we've built a liquid staking property into that market. So users are earning both interest as well as Cardano staking rewards. In these other asset markets, obviously, you're just earning interest because they can't be staked in Cardano. But then you allow the users to mint an interest-bearing token and use that asset as collateral in our system to open loans in other markets, like stable coins, like other Cardano native assets. So think of the Aave or the compound money market examples. That's kind of really similar to what we've delivered with pooled lending, algorithmic money markets on Cardano with Liqwid. And then the liquid staking component that you get from Lido is kind of also what we've delivered with the QADA specific Q token. It allows users to basically, like I said, capture that staking reward, but also earn the full amount of interest that's being paid out from the underlying assets, the underlying ADA loans, and the interest that's being repaid on those.
Okay, nice. Yeah, so there was questions actually from people. We'll go through the platform in a minute as well. It might be easier for people to understand how it works as well when we go through it. But what's gone live in version 1? So there's lots of features can come. What's live there now?
Yeah, right now we have an ADA market. So users can supply ADA. You can mint QADA at the current exchange rate. Once you do that, you're a lender in our system, earning interest plus staking rewards. So that 2x yield built into the QADA token that we're talking about here. And what's coming shortly after this in the days following mainnet launch are just support for new Cardano native asset markets. So stable coins and DeFi project tokens. We'll list the top ones on Cardano that we see sufficient liquidity for on-chain and can build out Oracle solutions for. But like I said earlier, Liqwid is the algorithmic money market solution for the Cardano ecosystem and native tokens. So yeah, we plan to support all of the stable coins and popular projects that are coming up on Cardano eventually. It really is just a matter of having a UI that really is nice and clean and crispy for having many different markets instead of just the one that we decide to launch with. As well as having, like I said, the liquidity and the Oracle solution needed to kind of pull prices for all these different Cardano native assets in a pretty secure, accurate approach. We're just building out that model right now, and close to being done with it. We've already got the first Cardano native assets Oracle price feeds that we need to launch this. It really just is a matter of now cleaning up some things in the off-chain, finalizing some tests, which we mostly have completed, and then getting the UI and the app ready for this, which is actually the lightest lift of everything.
Okay, so this is, I figured when we're just talking about it, it's easier to give people a visual of what's there now when we're talking through this. So this is the app that went live today. Anyone who tried it out on testnet, it's visually very similar to it. So the process for someone who wants to come in here, or why people would do this, they want to come in and they want to earn extra interest. One big question on this from people was, this is the APY that you can earn here, but on top of this, you also earn your ADA staking rewards, as far as I've read, is it?
Yeah, that's correct. Yeah, so the amount of ADA that's supplied to the market but not borrowed is staked to 16 different Cardano staking pools. We have a staking validator that we use to deploy these 16 different staking scripts. And basically, we are now staked to 16 Cardano single stake pool operators with the ADA market supply, essentially. These action UTXOs that are going to equally distribute the supplied ADA across all these different stake pool operators and delegations that we have set up. That is what we've gone live with on mainnet today as part of the ADA market. Again, right now we only have a single market, so users can only interact with the Cardano ADA market on mainnet. They can supply in it and they can borrow from it. Soon, in the coming days, we'll have support for things like Cardano stablecoins, Cardano governance tokens for various DeFi projects, listed at various collateral factors and liquidation threshold and parameters. And then users will be able to not just basically supply and borrow ADA, but supply ADA, borrow stablecoins, borrow DJED, borrow some other governance tokens, supply Shen, these type of things. So the world of possibilities really opens up nicely when you've built the type of composable interest rate market system that Liqwid has built. Launching with just an ADA market initially was more of a de-risking the initial bootstrapping of the system, as well as some of the specifics that we had to build into the ADA market, like the liquid staking components and some of just the other blockchain nuances. It made a lot more sense to just launch with a purely ADA market than try to launch with multiple other Cardano native markets.
Okay, and just on the staking rewards, are they paid out in one lump sum, or do people still earn the staking rewards even after providing liquidity? Where does that sit?
Yeah, so it's normal Cardano delegation. So every 5 days, you're accruing staking rewards based on how many blocks the pools have made in the last epoch. Essentially, the ADA is added into the market supply, so it just increases the Q ADA to ADA exchange ratio the same exact way that when borrowers with ADA loans repay those loans with interest, it increases the Q ADA to ADA exchange ratio, essentially. So it's basically paying interest and yield to the Q ADA holders every time we accrue both the staking rewards as well as the borrower interest repayments. So that's actually what's happening. And again, it depends on when the Q ADA holder actually redeems it. Like when they click that withdraw button that you see in the UI right now, when you redeem your Q ADA, you're basically burning the amount of assets that you've supplied, and you're withdrawing your initial deposit plus any interest that you've accrued since the time that you started lending in Liqwid. So yeah, when you do that, you're accruing not just your interest that's accrued, all those borrower repayments, you're also basically withdrawing all of the staking rewards you've accrued since you started lending in Liqwid.
And these rewards that it shows here, the APY, that is in ADA, is it? Or is that in LQ?
Yeah. So that's in ADA. This is all in ADA. The ADA market, it's the return, the APY for the lenders is all denominated in the asset that they're supplying, basically. So for example, in this case, all ADA, when we have stable coins, it will be all stable coins for the APYs for both borrowers and lenders. Okay, so in this example, just to clear things up, this does not include any staking rewards. We know Cardano has like a 3.7 to 3.5-ish staking return at this current moment. This doesn't include that at all. This is purely saying at the current exchange rate, right? At the current market utilization that we have, based on the amount of open borrows that we have, and based on the amount of liquidity that we have. Like right now, we can see there's around 1.9 million ADA deposited. Based on the current borrow demand right now, the APY to borrow ADA is sitting at 7.5%, and the earn rate is sitting at 1.3%. Okay. Now we have to keep in mind that is just for the amount of ADA that's currently being utilized. The unutilized ADA is being staked and being delegated to these multiple 16 different single stake pool operators and earning that 3.5 to 3.7% risk-free Cardano staking rate. So you have to take the net of these things. Okay. So the protocol is right now at 10% utilization. You have to take that 10% that's going to earn yield at right now 1.3%. And you have to basically weight that against the remaining 90%. It's going to still be earning staking rewards at the risk-free rate. And that's kind of, we need to build a better UI for showing that actually. Like we need to show users like in the Q8 top, we should show users the APY, but then we should also show users next to it, like the staking rewards APY or some other, mechanism to let them know, hey, you're earning a staking yield on top of this. But that's something that we'll try to get done, improve in the coming days, sir.
Yeah, hopefully things like this as well will get the message out to people and help them understand this a bit more. So over here, this is what they earn for providing liquidity. And you can see this one I just put in before the video, just so we have an example to show. I put in 200 ADA into this. So I would be earning 1.32% on that, and also earning my staking rewards on top of that as well. So for that, I got Q ADA into my wallet. We'll talk about that one in a second. And over on this side here, so this is for people who want to actually borrow ADA out of the system. And if you are borrowing ADA at the minute, the rate would be 7.5%. But unlike some systems, these rates change all the time depending on demand and supply. So even if I borrowed at 7.5%, that's not a fixed rate. That is going to, it's a variable rate. Same way you get from the bank, it's a variable rate. So I would borrow, and this rate goes up and down depending on how much is there in the demand and supply, isn't it?
Yep, that's spot on correct, Paul. So exactly as you mentioned, it's a interest rate curve algorithm that says, okay, at low market utilization, meaning in moments of high supply but low borrowed demand, the interest rates are going to be low, right? They're going to be favorable for new borrowers, but they're not going to be super high earn APYs for the suppliers, as they shouldn't be. The utilization in that market is low. As the utilization grows, we see the rates grow and move to the far right end of the curve. We have several risk parameters that we've built Liqwid system with, specifically for the moments where we move to the far right end of the curve with higher utilization to protect our suppliers, right? And the liquidity risks that exist when you have a market that's approaching 100% utilization. So things like the king point, essentially this is where the second interest rate slope kicks into place. It's at a market utilization for the ADA mainnet market at 65%. This is also a governance configurable parameter, so this can be updated. We can move it down or up if we need to through a community governance vote. But essentially, this is actually the point in the market utilization where you really start to hyper incentivize borrowers to repay and new liquidity to be supplied. You do that because an interest rate curve that goes from like gradually increasing all of a sudden becomes super steep at what we call the king point. Aave Compound, they have similar kind of dual interest rate slope models that they've built into their curve. So it starts gradual and then it gets super steep as you get to the the king point and beyond that, approaching 100%. And again, it's all a risk parameter to incentivize healthy actions in the market once you're reaching up to those higher levels of utilization. I also talked about Liqwid V2 in a tweet that I released. One of the things that we're focused on for that is supply and borrow caps for all of the markets. Again, another risk parameter that we have in our toolbox saying, hey, we can limit how much individual users are able to supply for, say, maybe a stable coin and borrow for, say, maybe a governance token, or maybe even we make it isolated collateral. So some governance tokens can only be supplied and used as collateral, but not borrowed, to mitigate some governance risk. So these type of things are really exciting and are kind of on the horizon for us really soon. It really is just a matter of, getting some UI updates, continuing the process of just like, getting the things that we have on the feature and product release lineup just pushed and shipped to mainnet. And, now that we have the protocol live and out in the wild, shipping products really does become so much more of a faster kind of iteration cycle for us now. So really excited about that process as well.
Yeah, I think it'd be great to see somewhere on the dashboard the overall stats like of the liquidity. I'd actually missed this initially, the liquidity down here of what ADA is there, but especially when more assets come into it as well. If there was some pages, not everyone's interested in it, but there will be lots there that want to dive deeper as well and just get a quick overview of what assets are put in as liquidity and what are actually borrowed out and things like that as well. But I know this is only the V1 day one, so stuff like that would be good. And I've seen questions as well from people talking about why would you provide ADA as liquidity and then borrow ADA on the other side? But this, once more assets are added into this, they will be able to provide liquidity in, say, you could provide liquidity in LQ token and then borrow ADA on the other side, or do it vice versa. That's all coming, is it?
Yeah, that's correct. So for isolated collateral, we may even specify it more. So you may only be able to like supply assets like LQ as collateral and borrow stable coins, just to like mitigate some of the risk even further. But yes, that's spot on correct is what we're saying, right? So we're saying that you're going to have Cardano native token markets where you're allowing users to provide stable coins, provide DeFi project tokens, and basically use those as collateral in our system to open loans in ADA, in stablecoins, in those other assets. Yeah, there's many reasons why users would take out leverage, even as the system exists right now, right? We wouldn't, try to tell you all the reasons that you go to the bank and take out a loan, right? So we're not going to try to sit here and discuss all the reasons why users, traders, arbitragers, crypto startups take out leverage. Basically, there's a myriad of reasons, right? The fact of the matter is we need a liquidity protocol in Cardano that allows users to lend and borrow ADA and Cardano native tokens in an algorithmic, model, and we finally have that now, right? And you're going to see the world of Cardano native assets being listed here soon. This list of assets to supply will get very long, and if you go to Compound or Aave today, you'll see it's a long list of assets. Why? Because they have mature oracles in these ecosystems, and they have really solid liquidity levels on all of their dexes. So the on-chain liquidations isn't so much of a stress for these protocols to list new assets and things. We're going to quickly get to that point in Cardano as well. Things are improving on that side pretty rapidly, and it really does feel like a matter of continue to work with the top Cardano projects in the DeFi, DAO, NFT space. The liquidity will improve. The infrastructure for price fees and oracles will improve. We're already seeing a lot of promising solutions coming online pretty soon there, even in that aspect. So yeah, I really do think that a lot of the people who are saying things like, why would I supply ADA and borrow ADA? One, that's not really the point. Majority of the use cases that we see here is going to be users who just supply ADA and then borrow stablecoins. That's like the canonical use case for why I use Compound and Aave today. I want to take my volatile crypto and supply it as collateral to open a loan in a safe, price risk mitigated stablecoin like DAI or USDC, for example. So, obviously Liqwid was built to enable this exact same use case, but on Cardano for Cardano native assets. So yeah, in days to come, when we start listing many different, Cardano stablecoins and project tokens, I think users will understand then, what it means to have cross margin and be able to use ADA to, go long or short some of these other assets by borrowing them and, trading them on a DEX and things like that after. So that's exciting. I definitely think, also there's this aspect of we really need to educate the Cardano ecosystem on how to safely use a protocol like this. Things like, max LTVs and liquidation thresholds are probably not terms most, Cardano DeFi users are super, super familiar with. So it's on us to go out and, educate our users, make sure that folks know how to responsibly use the platform. That's why we have things like the health factors shown in the app UI. So essentially when a user opens a loan, we can show them basically, how secure their loan position is and how close it is to collateral liquidation risk. This will basically notify a user when they're getting close to that one, that, hey, it's time to top up your collateral or repay the position. And we have a color scheme. So if your loan is in a super safe position, you see a green health factor, it's kind of, approaching risky, you see orange. And if it's in a really risky spot, close to liquidation territory, you see it as red. Aave does a very similar model, and it's great because especially, right now it's fine when you only have one asset, one market, but especially when you start listing multiple different markets. And in Liqwid system, for example, you can open a loan backed by 3 different collateral assets, right? So I can, in the future, open a loan backed by ADA, Dejed, and Shen if I want to, for example. In that type of environment, you really do want to make sure that you can easily tell what the health factor is based on the, the collateral value and the max, loan to values for each of those collateral assets that you provided. So you want to be able to easily tell your users, hey, this is where your borrower position is right now. You need to make some adjustments or you're in a good place. Yeah, this is the mainnet ADA market parameters. We can kind of go through these and talk about each one of them. But yeah, this is the parameters that are on the current market that we deployed to mainnet this morning.
Yeah, I did actually have sorry, Florian. Yeah, go ahead there.
Yeah, so I just want to say that these figures, they just don't pop up like this. So we have also developed a comprehensive risk framework to assess in a consistent way all the risk of the different assets that will be brought on the platform. This is going to be released soon, but it's already written and ready to be used. So basically, each time we want to assess if a token is eligible to be borrowed on Liqwid, because obviously we only want quality assets. Because also one of the risks would be that if we would accept like some low quality token, nobody would perform the liquidation because no one wants to have them, or the price is subject to high volatility, especially downwards, and this will be a risk for all the people that supply to Liqwid. So the three criteria that we use, or we will be using to assess the risk of an asset is the market risk. There is different criteria, but it's about the volatility. There is a technological risk, which is about has been the protocol been audited, since how long they are working, and if it's a DeFi project, we also look at how many users, what is the TVL on it. And the last criteria is the counterparty risk. So who is the team? Are they anonymous or not? Is there some decentralization, etc.? And based on all these criteria, there is a benchmark, and then we set the threshold for the borrowing, the TVL, but also the liquidation threshold and the liquidation bonus.
Okay, yeah. Because I didn't take out a loan on that test account, I can't show what you were talking about there, the different parameters. But I will have a few different tutorial videos coming out over the next few days, especially when there's more assets into it. And if you see there are common questions coming in on different parts of how this works, drop me a message anytime and I can try and create some content on that to help people understand it as well.
So once we introduce the multi-assets as collateral and as borrowing, we'll obviously have also a kind of fact sheet per asset where the people can see all these different thresholds, when it was voted by the governance, etc. And yeah, actually, we don't want to reinvent the wheel. So this kind of page exists already in Compound and Aave, and it's quite standard to have a kind of market dashboard when you list all the assets, and you also describe like all the risk parameters and the interest curve, which is applying to them.
Okay, just on adding more assets, do you already have a list of assets? You don't have to name them now, but list of assets that you will put in, or will that have to be done through governance? Obviously, governance is slower, but how is that process going to work?
Yeah, spot on. Great question. So we'll submit proposals through community governance, which will go into on-chain votes. And yes, like you said, we have a market creation, which is a proposal effect tied to Agora. So the Liqwid DAO is deployed as just an Agora instance. And then we basically use the market creation proposal effect to initiate a new market with a specific Oracle parameter and collateral parameters. And like you're seeing here, mainnet just parameters for that specific market. And essentially, we make some updates in our UI so that users can access it directly from our app. And then, yeah, we announce it and we launch it, and we basically have a new market now. The key thing is actually what you allow that max LTV to be, because that means the new market that you create, the new Q tokens that you mint, let's say if it's a DGED market, that Q DGED, it is going to determine how much leverage, how much you allow users to use that Q DGED as collateral in your system. And like Florian said, how much debt you allow to be minted against basically that Q DGED asset as collateral. The more debt you allow to be minted against that token, obviously, the more secure you need that token to be, both in its liquidity, both in its solvency, obviously, because, like Florian just mentioned, when these liquidation events happen, almost the first thing that a liquidator wants to do is to take the collateral asset that they just got at a discount and go to a DEX and sell it into ADA and basically capture their profit that they earned from completing that liquidation. And we see liquidators as completing a really key kind of role in the system. They help secure the Liqwid protocol from bad debt. They remove some of the default borrowers in the system before they turn into bad debt, right? So your loan is still fully over collateralized, even when it's over your max borrow limits and when you're in liquidation territory. But so much so that basically we don't have that much buffer before that loan could become under collateralized. So we need someone to come and repay that loan in a timely fashion. That's where liquidators step in, basically. That's the reason why in protocols like MakerDAO, Aave, Compound, Liqwid, the liquidators themselves earn the collateral at a discount. It's because they're completing a key and kind of timely task that we need completed in our system to stay solvent.
And this is something the community can do, is it? I've seen something in the Discord about there will be, or maybe it's out now at this stage, a package that people can run themselves on a server if they have some technical experience.
Yeah, absolutely. I believe it's going to be a Docker image. I don't think the liquidation bot is out just yet. We're running one, obviously, ourselves internally. We haven't liquidated any loans yet. And honestly, with just an ADA market, the risk to getting liquidated is very low. You basically remove the price risk because QADA, you have to keep in mind, QADA basically trades up and down the same way that ADA will. So it's going to move in value the same exact way, basically, because it's like a wrapped ADA, basically, with staking rewards and interest. That's all QADA really is at a specific exchange rate. So actually, it's more about allowing users to basically access basically the liquidity of their ADA while still earning that yield, basically. That's kind of like the key differentiator in our system. Yeah, but the liquidation bots will come out very soon here. Like, we have all the documentation for it. It's packaged up. We're just doing some kind of final pieces before we kind of make that public. But yeah, all of that work is pretty much complete and done. And sometime in the next few hours here, we'll open a page in our GitHub and we'll make an announcement about that so users can start running those and setting those up.
Oh, great. Even by the time, hopefully I'll have this one out later today, so it might even be out then. And any links or anything we talk about here, I will put down below. And when that is out, if it's open public, I'll probably go in and try and set one up myself. I might be able to record some of that process as well. On the loans, so people, there is APY there, but will you be incentivizing it with LQ? I've seen this in some other ecosystems where money markets launch and they use the native token to give extra yield for people who provide liquidity. Some do it on the borrow as well, initially to bring in TVL or bring in users into the system. Have you looked at this?
Yeah, absolutely. This is what, Compound kickstarted DeFi Summer basically with their yield farming program. And Liqwid is where our accounting is actually built directly after, the Compound protocol. We take a lot of our protocol mechanics from Aave as well, but direct accounting math actually comes closer to Compound even. So yeah, we've obviously, reviewed what they did with their yield farming program, and we have a similar mechanism. We call it the user distribution system, or yield farming, or the protocol incentives is what Aave calls it. But essentially, it's what you just mentioned, Paul. It's lenders and borrowers are being incentivized to use the protocol because they're earning a yield denominated in LQ on top of the APYs that they're earning as suppliers. And obviously, it's subsidizing the APY that you're paying as a borrower in our system. So yeah, we'll make updates to the UI once we come out with this. We'll probably come out with this around the exact same time as we come out with the new Cardano native token markets. As there's a whole system for basically allowing the amount of volume and interest generated in each market, whether it be ADA, stablecoin, or a Cardano, DeFi governance token, allowing that amount of interest that's generated from the borrow demand determine how much rewards are applied to each market. So kind of like letting the market kind of factor in just natural supply and demand, but also allowing a multiplier controlled by community governance to kind of impact how much LQ rewards each market on the supply and on the borrow side receives. So for example, if all things equal, we said that we wanted stablecoins to earn 2x more LQ rewards than say the Cardano ADA market, basically we'd be saying if the ADA market and the Cardano stablecoin markets both receive basically the same amount of interest repaid in them, you would still pay out 2x more in rewards to the stablecoin suppliers and borrowers. That would be like a 2x multiplier, right? If you said you want to just be natural, then the ADA market and the stablecoin markets will obviously earn the same exact amount because they generated the same exact amount in borrow interest repayments. So that's kind of the model that we're working with for the protocol incentives. Again, we can also make it like split between a market's borrowers and lenders. So say for stablecoins, for example, we see that we get a ton of supply for like Dejed stablecoin, but we don't have that much natural borrow demand, we can actually hyper incentivize the borrow demand and like either like just regularly incentivize or maybe not even at all incentivize, because maybe you don't need to incentivize if you have a lot of supply already, the supply side of the market. So you can really break down incentives to even like, you know, half the market if you really want to. And this could make sense for like, you know, maybe the ADA borrow side of the market in the early days even to kickstart that, you know, and definitely things for like stable coins, for example, in the future. So yeah, that's definitely one of the more exciting things. That's going to be a 4-year program of distributing LQ. It's almost, you know, 48% of token supply set aside for that. I don't know any other, you know, definitely not Cardano, you know, money market lending and borrowing protocol. But I'm not sure of any other lending and borrowing protocol that actually has anything close to like 75% of its token allocation set aside for its community to like, you know, be in direct control of and to own those tokens. So I would say, you know, Liqwid is actually with 48% going directly to the user distribution piece here and a total of 75% of tokens set aside for the community, you know, through all mechanisms, the airdrop, the DAO treasury, this user distribution mechanism, the CZI and swap, all of these equal up to 75% of token supply. I would say that's actually really bullish for like a community-driven money market protocol, and says something for the future of like DeFi projects and sophisticated DeFi projects on Cardano.
Yeah, I suppose that's a few good points there for people to pick up on, is just on the tokenomics and inflation and stuff like that. There's going to be more LQ coming into the market now to incentivize. There's different vesting schedules. So people just need to take that type of stuff into account as well. But we've seen some interesting things happen on Ethereum in terms of curve and different things that can be built on top. And you start to see in some cases where different other protocols want to pick up the token and pick up enough of them so that they can sway the governance to put more incentive on people to get involved in providing supply or borrowing their token as well. So there's lots of interesting angles there that I'm looking forward to seeing develop on Cardano as well, and something I'll document along the way as well, and just to see where we go if that narrative can pick up some speed on Cardano as well. It brings some interesting angles that can come in and exciting ones for people who are interested in DeFi and want to dive deeper into it. And on narratives like that, another thing that people talk about a lot is the 6x yield. Do you want to talk? We've touched on different parts of this, but do you want to just talk a little bit about how something like this works, how you can get the 6x or what we have now and what's coming?
Yeah, absolutely. And, you know, just to your point there on inflation, yeah, you know, Liqwid is on mainnet now. You know, the project is going to start distributing tokens through all of its different distribution allocations. That's like, you know, what a DeFi project does once it gets to mainnet. You know, we all talked about this stuff in our governance forum for, you know, well over a year now. We all knew this point was coming. Only 1.5% of the token was in supply. That's from the Discord community airdrop that we completed last January, you know, a whole year ago when the LQ token initially began trading. So it's like, this wasn't like a surprise to anyone. Like, this is stuff that's been in the public and kind of talked about for a very long time. Community debates, you know, hundreds of comments in Discord forums about proposals number 1 and 2, where we discussed nothing but the distribution schedule, inflation schedule for LQ and the like. So I just wanted to add to your point there, Paul, just to kind of clear that up. I think
it's just good to highlight these things because lots of people are coming into this type of environment new. They haven't got involved, especially in Cardano. As we get deeper into DeFi, there's lots of new concepts and lots of new things out there. So it's good to highlight these things and just explain a bit about how they work.
Yeah, absolutely. And I mean, to be real, like there's been Cardano projects that we've seen, you know, we won't name them, and, you know, we've kind of studied from them as case studies, obviously, second mover advantage, right? And they've released, you know, far more of their token supply in much shorter amount of times on mainnet than, you know, what we're planning for the Liqwid distribution and time for actually rolling out that many tokens. So you have to keep in mind, like the CZI, these tokens are going to be ADA, LQ, LP tokens on MinSwap that are going to be highly incentivized, you know, to be staked and to continue to, you know, provide liquidity on MinSwap and earn the fees there, but also, you know, contribute to basically the protocol's own liquidity. So that's the kind of important concept to keep in mind here. It's not like, you know, these tokens aren't all like, you know, entering the market at once. Things like the 1% that we actually allocate to the MinSwap, LPs after this is going to be distributed over 6 months. Our core team tokens will be vested over 2 years, and none of our core team members are doing anything with our LQ other than putting it in staking and basically voting with proposals on the protocol. Like, we're here to build products, and we're here to build exciting features on top of Liqwid for years and years to come. We're locked in and loaded. We've mainnet was fun, and we enjoyed the whole process of launching the protocol. But now we're just ready to build 1,000 different products on top of it. And half of them we probably can't even talk about right now because they're still under NDA. But like, that's the real plan now. It's not so much like trying to focus on any one thing. It really is just trying to bootstrap the DAO, trying to make sure that the DAO actually has some notion of protocol owned liquidity starting out, and that can be like used as a functional DAO. This is why we created the Swiss-based Liquid DAO Association, so that we can actually sign legal contracts and act on behalf of the DAO, and have community-driven proposals that drive value into the Liquid ecosystem by saying, hey, we're gonna build this new exciting product with this fintech company, and they're going to integrate with Liquid, and all their users are going to be able to access eternal wallets and lend and borrow on Liquid. And like, how cool would that be, right? We're now touching like real world users basically in finance.
I was going to get into the 6x yield, but you just mentioned CZI, and just for people who mightn't have heard of this process before, again, we'll keep it high level because I realize I'm taking up lots of your time here now, and there's lots of people looking for your time today. But just on this, the Liqwid collective Zap-in with MinSwap, can you give the high level of what it is and protocol-owned liquidity, how that helps stabilize things as well?
Yeah, absolutely. And I want to thank the MinSwap team for being the real kind of the Cardano disciples, if you will, when it comes to protocol-owned liquidity, and just really these liquidity bootstrapping tools that they've built at the MinSwap Launch Bowl kind of product lineup. They have the LBE, the liquidity bootstrapping event. That's for projects that have no tokens in circulation, and are trying to basically launch 0 to 1 in terms of their liquidity pool on MinSwap. And the CZI is more built for projects that have some initial liquidity, but are now trying to significantly boost that liquidity on MinSwap, and also give their DAO the LP tokens for that trading pair that will earn fees for the DAO, basically in a passive way, where the DAO can then use the revenues from those LP tokens to fund different community initiatives and projects, basically. So for right now, we're launching the Liquid DAO treasury. We don't have any in terms of protocol and liquidity outside of the Aqua Farmer royalties is the only notion of protocol and liquidity, and it's obviously a very, very small amount of it. When you look at projects like MinSwap and what they've managed to build out just by going through the LBE process and having their DAO treasury own kind of 50% of the tokens proceeds generated from their LBE, they're now earning fees on all those LP tokens and can put those fees to work, whether it be paying for future audits, whether it be paying for, future contractors who are helping work on future protocol updates and features and products, right? A myriad of things that you're going to need to pay for when you're a DAO, whether it be audit, developer cost, marketing services, you name it. Your protocol-owned liquidity is what you're going to rely on as your DAO treasury to be the yield source that basically earns some revenue for you that you can basically then put to work towards growing the actual ecosystem. So this is a really great chance to basically also allow other users who were interested in acquiring LQ, but not with the the slippage that they would incur on certain dexes because of the low liquidity. They can now access a decent bit of LQ without having to worry about price movements at all, thanks to the CZI. It's just another mechanism basically for us to really expand the LQ base. And we think, at mainnet launch a year ago to date, basically, we completed an airdrop of 1.5% of tokens just to basically all users who were in the Discord and who were active in Discord. Now we're saying, a year has passed. We've heard a lot of community members who weren't able to participate, 2 new members who have joined the Liquid ecosystem who are really interested in acquiring the token. We've heard a lot of calls in our Discord for a public sale of the LQ token. We were kind of adamant that that wasn't the route that we wanted to take, and we feel much more bullish about a collective Zap-in, mostly because of what it does immediately for your protocol and liquidity and kind of bootstrapping that LQ ADA LP token trading pair on MinSwap. And I think that's really the kind of goal here for the DAO itself, because the DAO is going to be the owner of some of these LP tokens. And yeah, you know, things are really kind of moving forward for a DAO when you have revenue that it's generating and it can put to work and not have to basically liquidate the principal itself. So that's kind of what we're doing with the CZI. Yeah.
If I may, so the question, Paul, was how does that work? So on February 7th, we will bring a total of 630,000 LQ. And then it's like in a pool, and the market, everyone can bring some ADA in the same pool during the next 7 days. And then after this 7 days period, there will be a kind of swap between this asset, 50-50. And at the end, for example, I make an example. If we bring, I don't know, 630,000 LQ, and there is 5 million LQ or ADA, then the protocol of Liqwid, of the treasury of Liqwid, will earn the half of it, and the users will earn the half of the total LQ. The price is determined by the last 7 days. And if there is not enough ADA at the price of the 7 days to convert or to perform this transaction, then the remaining LQ stays in the wallet of Liqwid and they go back to the treasury. So this is a high-level process. How does that work? It's a kind of swap with two counterparties that bring each party half of it. I just also want to touch to it why we do that and why it's also important for us. So as Dewayne said, we can really give an opportunity to everyone to enter early in Liqwid without doing any slippage. For us, with all the ADA collected, it will allow us also to de-risk our protocol, because we will bring this ADA as a supply on Liqwid protocol in order to be a kind of buffers, and also the protocol will earn from this ADA that are supplied on the market. And also, I just want to touch about the utility of the LQ token. What is it and how does that work? So on Liqwid, we have what we call the stability pool. It's a kind of insurance layers where everyone can deposit their LQ. And if there is a negative event, we would use the LQ from the stability pool to reimburse or to pay for some damage that happened. As counterparty for that, people can earn a LQ stacking reward, which is around 5%. Once there is a dividend that is switched on through a governance vote, people will be able also to receive a percentage of the interest paid by the borrowers. And finally, in a very soon futures, they will be able also to use their LQ as collateral on Liqwid and to borrow against them.
Okay, yeah, that's actually good. That got to one of the questions I had about the LQ token and what it can be used for, and bringing in the idea that some of the protocol fees can go to token holders is something that I like to see as well, and look forward to seeing things like that. Kind of deviated there. Thanks for talking through the process here as well on the protocol owned liquidity. And there is a Twitter Spaces on Monday for anyone who wants to tune in and get more information on that. But to close up, actually, I have a few questions the community submitted, but I got distracted on this one.
Absolutely.
Just to talk high level through this of what it is or how something like this works.
Yeah, happy to. So basically what we launched today is the first two of these. So you have the minting of QADA and the supplier interest, right? That supply APY is built into the QADA token. So now anyone holding QADA in their wallet is earning both the liquid staking yields, right? From just the delegation to Cardano SPOs that we completed to those 16 different stake pool operators. And they're also earning that yield that you see in the supply APY column right now in the app, whatever that current yield amount is, right? So the first two of the 6x yield for ADA suppliers, that's already live today, basically. It's already built into the QADA token. As I said, I'm pretty sure Liqwid is the first protocol, not just in Cardano DeFi, but in existence, to actually have a single composable, fungible token represent yield from both staking rewards and from supplier APY, from borrower interest repayments. We've heard of other protocols that do really cool things, obviously, like Aave and Lido compose together with the staked ETH market on Aave, and that allows you to basically take the Ethereum liquid staking derivative from Lido and supply it and earn yield on it and mint a staked ETH is what the token is called, right? And there's like 1.7 or something billion dollars of a staked ETH minted. Why? Because users who are holding staked ETH say, I don't want to just earn staking rewards. It's kind of like users who are just staking ADA in their wallet right now. They say, I don't want to just earn the risk-free rate. I can earn actual yield beyond that, a marginal rate of return based on the current supply APY by just lending this out in Aave. And Aave has a really cool system that they built. It's kind of like isolated collateral for the Aave staked ETH market and asset, meaning you can supply it and mint Aave staked ETH, but you cannot borrow staked ETH in Aave. So similar things to what we're going to do for the LQ token, actually. And Aave actually does the same thing for their Aave governance token. You can supply it in the Aave market, but you cannot borrow the Aave governance token. You can only supply it and use it as collateral to borrow other assets. So you protect these kind of like unique types of assets, whether they be things like liquid staking derivatives or whether they be things like governance tokens that you don't want borrowed because of real governance risks that exist. So yeah, moving forward, now we have the third piece here, which is basically the protocol incentives. So this is for lenders, and we should update this chart because actually, after talking to the devs more, we may not even require users to stake the QADA itself, just actually holding it in their wallet and actually just querying the users who have, basically holding QADA in their wallet and have minted QADA on the protocol. We should be able to get all the information we need to process rewards for those lenders, basically. And we shouldn't require lenders to actually stake their QADA in the protocol. Earlier, when we initially started developing Liqwid, we were a little more primitive in what we were doing with polluted smart contracts, and staking QADA was a simple way for us to denote all of the suppliers in the system easily. And that's kind of why we ran with that model for how we were going to do the liquidity incentives for the lenders. But yeah, basically we're saying you're going to earn LQ just for using the protocol as a lender and minting QADA, right? So that's going to be your third yield source. The fourth is basically staking those LQ tokens in the Liqwid DAO governance portal. And LQ staking is one of the first things, turning on hopefully in the coming days here. We've already completed all of the code, all the contracts for this. We're now finalizing some small things in the UI before we make this public. This is LQ staking and LQ voting as part of the governance portal. Again, these are all actions that you're doing in the Liqwid app, directly next to the same dashboard tab where you're lending and borrowing your ADA. You'll be staking and voting on different proposals. And when you do stake your LQ tokens, you're earning a fixed 5% APY. And that's just kind of like the base, that everyone staking LQ is earning, kind of like when you stake your ADA, everyone's earning that same, risk-free yield, around 4% currently, right? Similar mechanism. This will also be the start of the Aquafarmer boost. So if you have an Aquafarmer in your wallet and you're staking LQ, you will have a boost applied to your LQ stake amount. So if I, for example, have the rarest level of Aquafarmer, and I have, say, 100 LQ in my wallet that I'm staking, basically because I have the Aquafarmer boost being applied, because it's in that same wallet as the LQ, that's the connected wallet that I'm staking LQ from, I have a boost that's going to apply basically a 5% increase to my LQ balance. So from my rewards calculations perspective, it'll be as if I'm staking 105 LQ. And that's kind of where the Aquafarmer boost comes into play, and the whole utility behind the Aquafarmer collection. That's yield source number 4.
That was another community question, actually, was the Aquafarmers, so I can take that off my list.
Absolutely. And there's another concept and component to that too. So Florian was calling it the stability pool. That's similar to a different mechanism. We actually have what's called the safety pool. It's named after Aave's safety module. And it functions the exact same way as Aave's safety module. It's basically an insurance layer for the protocol where LQ stakers basically take on some level of risk in the fact that if a shortfall event ever occurred, the safety pool could potentially be slashed. It would go through a community, governance vote, but it could potentially be slashed in order to basically make whole any impacted users from a shortfall event, any lenders who basically lost any principal as a result of a shortfall event. Keep in mind, Aave never had to use this before. It is truly an insurance layer to your protocol. It's a system that you hope you never have to kind of execute and use. But it is there for that worst case scenario when you have some shortfall event, bad debts being created in the system, these type of things, right? I think it's prudent for a system that generates, loans and extends credit to users based on, their collateral backing to have this type of insurance layer built into it. And the fifth layer of, source of yield, if you will, is basically saying, now that you have, staked your LQ, and you see that protocol revenue plus LQ, right? Like that's kind of like the second piece of staking LQ. Not right now at launch when we initially deployed the governance portal, but shortly after, and the code is already done for this. Like, we could turn it on at launch, but because of regulatory and compliance reasons, we won't, and we'll instead have a community proposal to pass this. Something what, MintSwap's calling the fee switch, and Uniswap and many players call the fee switch, but essentially a protocol revenue that accrues to the LQ stakers and is basically a % of all of the interest that's repaid on Liqwid across all the different markets. So ADA, DEGED, Shen, all the different markets that we'll have. LQ stakers are going to earn a % of that yield basically as part of the, the quote unquote fee switch. And basically that yield will be paid out in ADA, in DEGED, in Shen, whatever the actual market is that users are borrowing assets and repaying that asset with interest in. The LQ stakers are going to earn basically a % of the total amount of interest repaid. And that kind of rounds out the fourth yield stream. So you have that fixed LQ 5% yield, which is again paid out in LQ, but then you have this protocol revenue component, which we're soon, shortly going to turn on. And that's going to, on top of that 5% APY, provide some marginal, % of return paid out in all the different assets borrowed on Liqwid. Then you can actually, for the fifth source of yield, you can take the LQ that you earn, that 5% APY, and you can take any of the other assets that you earn, swap them into ADA, and if they're already ADA, perfect. And now you can actually just go ahead and LP on the LQ ADA LP pair on, MintSwap, Sunday Swap, Wing Riders, and you can earn fees doing that by holding those LP tokens. And then obviously the sixth yield stream, and it's funny because it can extend even past 6, but we stop it here just for, just to be reasonable. But the sixth LP stream is basically staking those LP tokens on the DEX, right? To earn protocol, governance tokens from the DEX, as well as, LQ incentives, like from the, MintSwap incentive program that we're going to have following the CZI. So, that is the sixth. But then, okay, now that I'm staking my LP tokens and earning these rewards, okay, now I'm earning LQ and MintSwap. So, there's technically a seventh thing I can do with those tokens. So, and it just continues on and on. It's a really kind of self-fulfilling positive feedback loop of liquidity begets liquidity in this early supplier cycle. And then it moves on towards basically having ADA and minting Q ADA, and then just generating all these different yield sources just off the fact that you're holding Q ADA in your wallet, basically. And it all starts with like kind of, step 1 and 2, but leading into step 3 being like, I can just earn now basically an LQ yield just by being a lender in Liqwid for the first 4 years as part of this like, compound yield farming incentives that we saw compound launch DeFi summer 2020 with. Yeah.
Okay. Thanks for going through all of that. And hopefully it makes sense to people, the different streams that are there now, because there is lots of questions out there. And I suppose you say it can go on and on. If you are incentivizing certain assets as well with LQ initially to bring in more suppliers and borrowers, then that could be another one that's thrown in on top of that as well. But I think I have 1 or 2 questions from the community, and then unless there's anything else that you want to go through, I will let you go back to answering questions and going on with launch. But on any country restrictions on actually using the protocol, or is it open? Is it fully decentralized for everyone?
Yeah, it's open. It's fully decentralized for everyone. No restrictions on country location. And just to your last point, just to confirm, the currently 2x yield sources, those first 2 revenue streams, the actual staking rewards coming from the stake pool operators and the supplier interest APY, that's all that's live today. But again, once incentives turns on all these other mechanisms, then you'll get the other 4 yield streams for the ADA suppliers specifically that we just reviewed. And yeah, no restrictions on country for using the app at all.
Okay. And another one that someone asked as well was, will any of it be open sourced or for other people to build front ends, or is it sticking with Liqwid for now, Liqwid Labs?
Yeah, a decent bit of it will be open source actually. So the AP, all the APIs are going to be open source immediately, right? We already have our DeFi Llama kind of API query set up so that they can read our TVL and report that. But we also obviously want developers to build really cool things on top of Liqwid and integrate, Liqwid and QADA into their own apps. So we've built our APIs to enable this. Plan to make those open with really good docs. Also, the liquidation bot, something we're going to open source today, allowing users to basically, run a bot in a packaged up Docker image that we've created to allow for securing the protocol, against any bad debt ever accruing in it. As far as like other components of the system, we're definitely interested in open sourcing things over time. There's an interesting kind of dilemma on Cardano where you have a decent bit of projects who have decided to not open source and kind of create a more competitive ecosystem at the terms of like, building custom batching solutions and, things that Liqwid has had to do as well, obviously just for the UTXO contention reasons. But now what you have is a scenario where, a team like Liqwid has built something for the past 2 years that, we see as truly innovative. And, we're just scratching the surface for obviously what we're going to do with it. And you have, other DeFi teams and a real Web3 issue in general where there's actually a stronger incentive rather than to like, build something generally innovative and to build something that, is for the first time created and not just a fork, copy pasta of some other protocol that exists on Ethereum already. That incentive is actually super low compared to, right, the SushiSwap incentive to go along and fork a protocol, change the logo, make some, very kind of menial change to the code base, launch with a new name, and all of a sudden you're, $1 billion ecosystem. Actually, the incentive for really competent DeFi development teams is the SushiSwap route, right? And it's almost like, wait, why wouldn't you do that if the route to, instant, profits and, just like clean 1 billion in TVL is there to just fork, Aave and Uniswap and launch as like a food token? Why wouldn't you do that? It actually is way more laborious and involved to try to go the innovative routes and build something new and exciting that people haven't seen for the first time. So what you end up there is a really terrible, perverse incentive for really competent teams to not build, but to rather just fork and redeploy. So we're trying to like see, how do you balance that? How do you balance like protecting the IP that really owns, that is really owned by the Liqwid DAO and the community members in the Liqwid DAO. We see things like Aave V3 and Uniswap V3 launch with business source licenses, right? And actually we're starting to see other DeFi protocols like Volts, the interest rate swaps protocol, for example, went to Uniswap V3 and licensed a part of the Uniswap V3 code base, basically said, hey, we'll pay you guys, I think it was 1%, maybe up to 5%, I forget the number. It might have been 5% of their governance tokens that Volts paid out to Uniswap's DAO treasury, basically, and Uniswap's treasury basically said you can license a part of the Uniswap smart contract code base for your interest rate swaps protocol, because we think you're building something really cool and innovative on top of Ethereum, but also this is the cost to do so because this Ethereum Uniswap V3 code base is owned by the DAO. So there's that whole component to it as well. I think, crypto Web3 protocols are quickly moving to that. Look at Starkware, for example. You have Visa and MasterCard building on top of Starkware, and it has closed source components, a lot of it actually. You have, a lot of the top Solana, applications, for example, are, fully closed source. So I definitely think that there's a hybrid model that's coming. We open sourced Agora, for example, and we made that like the Cardano DAO tooling for anyone who's basically a DAO developer who wants to, initiate a DAO on Cardano that has on-chain governance, not just on-chain voting, but actually on-chain proposal execution, on-chain treasuries, multi-sigs, you name it, all the tools basically you would need to really kickstart a DAO and community governance on-chain. We've built that into Agora, right? And, Liqwid directly dog feeds that and uses that in our V1. And you'll see that with the governance portal that we launched in the next couple of days here. But really, like, we've also built Agora Pro, right? We also have built some premium extensions on Agora that are not open source, that we plan to, collect consulting fees, helping different companies interested in using Agora Pro specifically, integrate, set up, run these type of things. Because at the end of the day, Liqwid Labs we're still a business. Like, we have investors. We did a seed round at the kind of start of last year-ish, end-ish of Q1 of last year. We still have to earn revenue as a business, right? Implementing services above and beyond just like launching Liqwid and the products on top of Liqwid. So that's kind of what things like Agora Pro allow us to do. And obviously, again, a lot of this comes down to like the IP for both Liqwid, Agora Pro, and trying to balance the revenue model that we need to have as a startup. But the IP itself is owned by the DAO, and you always have to remember that and keep that in mind, and allow the DAO to make like sound decisions around owning that and protecting that IP that don't involve like sushi swap, like attacks basically on your IP is what we're trying to avoid against. But yeah, we plan to open source these over time.
I see we're just gone over the hour, so we'll close it up with any closing thoughts that you have. Actually, any common issues that people are seeing that you'd like to put out there, or any closing thoughts in general on how things have gone?
Yeah, I just want to thank the whole Cardano community. I know that, your patience during this process, it's, we've asked a lot out of you guys over the last 2 years. You guys have been incredible in both supporting us and both, asking the right questions, critiquing us when we needed it. Just really making sure that we were always committed to this community and heads down on the vision and the goal. Really, really proud for where we are today, and, was up all night with the developers. They're super excited. They're resting up right now. A lot of them are in Europe and kind of spent the whole night up just working on deploying the protocol. But yeah, now it's time to build an armada of products on top of Liqwid. It's time to really turn on community governance and get really, people excited about voting and submitting proposals. And yeah, we're just excited to be able to list some really strong Cardano native assets as markets on Liqwid. Yeah.
Great. We hope it's going to be the start of a new era of DeFi on Cardano, and also in the future, also a real finance use case that will be built on top of Liqwid.
Well, look, thanks very much. Again, congratulations on launch. We should do something in another month or two, see how things have gone post-launch, what V2 is starting to look like and things like that as well. So you're more than welcome to come back on and give updates. And as I say, if there's common issues that people are having out there or tutorials you want put together, just reach out anytime. Anyone new to the channel, if you want to see them kind of things, make sure you subscribe, comment, questions, or anything like that below. I'll try and get the answers for you in some follow-up videos, and share it out if you think others could benefit from what we've went through here. Thanks for watching, guys. Thanks for your time, and we'll talk soon.
Thanks for having us on.
Thank you. Bye-bye.